Right now, you've got Chinese people that are doing everything they can to convert their money out of yuan. And what that's creating is that is creating money flows coming out of China. Never mind that there are laws against it. Clearly, the Chinese want to prevent as much of that as they can. But the reason I think that the yuan has some serious problems, I mean serious to the tune of 11 to 12 to the dollar. So nearly doubling the current exchange rate. In my mind, that's what's coming.
In the 1990s, he created a billion-dollar copper producer. In the 2000s, he launched what would become one of the world's top primary silver producers. And in 2015, he started what he believes will be his third billion-dollar company. The one gold stock to research right now.
Visit crushthestreet.com/investright.
Well, hello, everyone, and welcome into crushthestreet.com. We got an excellent interview today. In the pre-interview here, we've just had such an enormous amount of information that we're going to cover, and it's very, very important to how to proceed forward in this 2016 economy. His name is Trey Knippa, and his website is shortjapandebt.com. And he's responsible for identifying, researching, and continuing to refine the short Japan debt trading strategy. And you can open up an account through his website, and Trey will serve you as a commodity trading advisor, managing your account with expertise and unbridled enthusiasm for the financial markets. And I believe you're going to get a taste of that in this interview. And he's been a trader on the CME since 1996, and he's a regular contributor on CNBC, Bloomberg, Fox Business, Al Jazeera, and many more. And let's get right into it. Trey, thanks so much for joining me today.
Absolutely. It's great to be with you again.
Trey, 2016, the stock markets had the worst start on record. Now, it's way too early to say that we're going to have the worst year on record for the stock markets. We're just a few trading days in, but it's been the worst so far, and China is all over the headlines, kind of the catalyst for why we are seeing so much turmoil in the markets. Of course, the story is much bigger than that, but let's get your thoughts on the economy and what we are seeing with China in the headlines.
No problem. In the introduction, I do want to point something out to the listeners. Granted, my website is Short Japan Debt, but today we're going to be talking about actionable trading ideas and actionable, say, a macroeconomic thesis that definitely goes outside the scope of just talking about Japan. So I would encourage listeners, if they see that website, don't think that I'm just a Japanese-only guy. That's not my only trade, and that's not my only focus. And I think this interview will absolutely prove that. Clearly, we can talk about Japan and the specifics of my strategy there, but we're also going to talk about other things and other market ideas. So, like I said, just because I say shortjapandebt.com, let's not pigeonhole me to just that.
Okay. Well, like I said, having the conversation before the interview, I mean, your knowledge is across the board, and that's important. So, yeah, let's get your thoughts on the economy.
Okay, so let's talk about China, why does it matter to our investors and the listeners, and most notably, let's talk about an actionable trade idea. Here you go. The Chinese yuan has only just begun to depreciate. Right now, you're trading 6.5, 6.6. Right now, you've got Chinese people that are doing everything they can to convert their money out of yuan. And what that's creating is that is creating money flows coming out of China. Never mind that there are laws against it. Clearly, the Chinese want to prevent as much of that as they can. But the reason I think that the yuan has some serious problems, I mean serious to the tune of 11 to 12 to the dollar. So nearly doubling the current exchange rate. In my mind, that's what's coming. And to understand my thesis, this requires a little bit of economic history. The Chinese started this economic expansion by grossly improving their export market. How did they do that? With a very, very undervalued currency. So suddenly their labor became very cheap, right? If you're paying in this very, very undervalued yuan, then great, I can buy more labor for less money. That's the whole idea. Right. So suddenly they became this labor miracle, and they started growing and improving their exports, right? Well, once you got to 2007, 2008, we had the global financial crisis, and suddenly global economic growth noticeably slows down. So we also have to agree on something right now. The Chinese and their leadership is motivated by one thing. Technically, that one thing is corruption and holding power. But how do you hold power in a communist environment? These aren't democratically elected officials. So all they want to do is protect their power and protect their positions in the government. In a socialist and in a communist environment, how do they lose that power? They lose that from revolution. Okay. What is the fastest way for there to be some sort of a revolutionary event in a place like China? Easy. That's hunger. If your people are not working and your people are hungry and they can't afford food, that's how revolutions start. It's happened over and over and over again. So the Chinese leadership knows that in order to keep their jobs and in order to keep that power, and clearly because, like I said, they're motivated because they're power hungry and the corruption that goes along with that. But in order to keep that job, you got to keep the people fed. So here, 07, 08 comes along. The export story is now gone. And so now the Chinese have got to keep these people working. So what do? They start a credit expansion. And what do they use that credit for? Infrastructure spending, building real estate, high rises, that sort of thing. So as banks lend more and more money, those banks become more and more levered, meaning that they've lent out many, many multiples of their deposits and many, many multiples of the capital that they have on hand. Now, let's say a Chinese bank lends money for a high-rise apartment building. Well, clearly the developers of that high-rise apartment building, hey, great, we've put a whole lot of people to work building the high-rise, but at some point I've got to either lease those properties out, lease the units out, or I need to sell those units. Why? I've got to generate revenue in order to pay the loan back at the bank. Well, what happens if, my salespeople are terrible, I can't manage to sell any of these properties, I can't rent them out? So now suddenly the bank says, hey, where's our payment on this loan? And the developer says, well, I just don't have it. We're going to have to restructure the debt, et cetera, or eventually there could be a foreclosure. So that, I think, is what is literally just starting in China. Are these loans going bad? Okay? So if the loans are going bad, now the banks go, oh, God, we're not going to be getting this money back. So suddenly, if I start losing on those loans, now my capital position looks worse and worse and worse in these banks. So what I'm telling you is that you've got a massive restructuring of the Chinese banking system, and who's going to cover that tab? Who's going to pay for it? They're going to pay for it by printing more yuan. It's coming straight out of the People's Bank of China. That's who's going to finance this. So if you've got all this debt and you've got to recapitalize the Chinese banks, they are going to print more yuan. Isn't it now logical that the Chinese investors and the Chinese owners of yuan, heck, they're going to the black market to try to get their money out? I was talking to some friends of mine in Mexico. They're Mexican developers, and they have had buyers of Mexican real estate. And who are they? They're Chinese people. And the Chinese people are trying to get their money the heck out of there because they certainly do not want to hold yuan. That day is coming. So right now, Chinese yuan trading 6.5, 6.6. In the futures markets, trading a little bit higher because people are obviously very bearish. That is a trade that, in my opinion, is a complete layup. The Chinese yuan is going down, and it's going down a lot. It's only just begun.
So, Trey, let's talk about that. In relation to what? Are we talking about the Chinese yuan in relation to the dollar? And
yes.
Let's talk about let's compare China to the U.S. and talk about why China is going to devalue quicker than the U.S. dollar, because I think we probably both can agree that fiat currencies aren't the place to be. But if you think that one is going to devalue quicker than the other, well, you want to be in the one that's going to fall less badly, at least for the time being. So maybe your thoughts on that.
Well, and the other thing that you can do here is that, so in my Japan position, I'm very bearish the yen. You do realize that my thesis is that at some point the conversion rate of the yen is going to go to infinity. That is my target in yen. I don't have one because you can't there is no way they'll ever pay back their debt, their government debt, and the only way they're going to do that is by printing more yen in order to pay down that debt. And never mind that they've got somewhere in the neighborhood of a 50% fiscal deficit. The Japanese government spends twice what it makes in tax revenue. So, I don't know, maybe more yen are coming. So in my trade on short Japan debt, I am long gold and short yen. So if your listeners were unhappy being long U.S. dollars against the Chinese yuan, then maybe they should consider something like owning gold versus the Chinese yuan. By the way, that trade has performed really, really well in this first week of trading because gold has surged higher. I think that this Chinese story absolutely supports gold. So you just have to pick where you want your long leg. If you're going to short a currency, you got to be short it versus something. If I could borrow money in yuan, I would borrow as much as I possibly could in yuan because I know that as the yuan devalues, it's going to take me less and less yuan to pay that loan back, right? So I'm horribly bearish the yuan. One trade that you can do is that there is a U.S. dollar versus Chinese yuan contract that trades in Singapore. It's called the SGX. But this is what I do for a living. If people want to email me and ask me how to do that, they need help executing that. That, like I said, that's what I do for a living. So I'm happy to walk through any of your listeners who want to do that trade. We can figure out risk tolerance, how much they want to, how big their position size needs to be, and that sort of thing. But there's a long ways to go in the yuan, and there's a pretty easy way to execute it, and that's through that futures contract traded in Singapore.
Okay. Yeah, no, that's incredible, and a lot of really logical ideas you have there. So let's talk about inflation, because that's what you're talking about, what's happening to the yuan. If I can talk about the U.S. for a moment, since 2008, we had a base currency around 800 billion, and then it skyrocketed up to 4 trillion. And a lot of us thought, hey, this is hyperinflation. The currency supply is expanding out of control. But we saw it offset with the slowdown in the velocity of money, which dramatically offset that. It offset the inflation. So all of that money that should be...
Let me push back on you.
Huh?
Let me disagree.
Okay.
Of course you've seen inflation. Look at bond prices. What are they? Inflated.
Sure.
Look at stock market values. Inflated. Here's what's even more puzzling. Since 2007, corporate debt has more than doubled. And that corporate debt is not being taken on the books in order to finance new projects, in order to do capital expenditures, any of that stuff.
Right.
It's used to finance share buybacks. So here these balance sheets actually look worse than they did in 2007. Interest rates are insanely low. What in the world are they thinking? Right now they need to be keeping powder dry, saying, hey, when times are good, let's pay down debt, let's be lean. And then when times get a little slower, okay, we've got to pivot a little bit, take on some debt. They've actually doubled their debt as our economy supposedly has been expanding and the stock market's been working higher. Why? Because they're financing those share buybacks.
Right.
So it really, really puzzles me. When people talk about, there is no inflation. Well, healthcare prices are working their way higher.
Oh, yeah.
Equity prices are high. Look at real estate values absolutely are inflated. They have gone up. Now, here's what I found puzzling is that whoever inflation hired to be their PR person, I want to hire that firm because, man, they are doing a great job.
I hear you. I hear you, Trey.
Yeah, inflation's nonsense. We don't want that.
I hear you, and the way Mike Maloney puts it, he talks about it being in all this base currency supply has helped the stock market. It's helped asset prices, but it skipped Main Street. It didn't go into Main Street because of the way the money is sitting on balance sheets of the bank. And I'm just wondering if you actually think that this money is going to enter the economy and in a way that's going to really affect oil prices and the price of food. And I know that we have seen inflation. I mean, don't get me wrong. I'm not an advocate for the government numbers at all. But inflation to the extent of hyperinflation on Main Street, where we really do see a panic in the fiat currency system. And, I'm having this conversation because I want to understand China, what we're going to see there.
Sure. It just shows up by a noticeable. I mean, that is inflation doesn't exist outside a monetary system. You have to have a monetary system in order to create inflation in the first place. So that is a monetary side effect of what goes on with these central banks. So that will be where that shows up. The other area where you've got inflation, and guess what? this inflation hurts senior citizens. If there's anybody out there on a fixed income right now, I mean, every time Janet Yellen comes on TV, even though she looks like a sweet little old grandmother, my parents, for instance, my parents are in their mid-70s. Their savings earns nothing. And yet the head of the Fed is sitting there targeting, trying to make prices go up. Oh, we really want inflation. But what I find a little bit puzzling here is that if you actually got this inflation that they're quote unquote targeting, well, gee, let's be careful what we wish for. Suddenly, Social Security expenses go up because they have those inflation adjustments for that. So if inflation actually happens, that's bad, and the federal government doesn't want that from that standpoint of expenditures and things like that. So you've got every incentive in the world to say, well, we just don't have any inflation, but we really, really want some. Inflation is a side effect, and it's a negative side effect. So bond prices are inflated, so incomes from fixed income investors are very, very low. Meanwhile, the prices of other things, most notably real estate, have worked their way up. So you do have inflation. It's just how you want to report it.
So Trey, let's talk about China a bit more and how inflation will set in within this country.
So the way I see it is that they have inflated their real estate values because they just keep throwing money, throwing out more building, more construction, et cetera, et cetera. That bubble will pop, most notably. But what they're going to be doing is that they're going to be flooding the market with yuan, and so suddenly the yuan gets cheaper and cheaper. So why does that matter? Well, that matters for Chinese people, but that's going to happen. That'll happen over time. That's the slow bleed is what the politicians want, and that is the very nature of inflation. If the things I spend cost 2 to 3% more per year, well, I don't notice it quite as much, and I absolutely see that happening to the Chinese.
Mm. And do you think this will drag out as long as this Japanese depression has drug out, with artificial stimulus, low interest rates? I mean, do you see this as something that can take even longer, maybe a 50-year period? Because
no, I see it happening shorter because they expanded so much quicker.
Okay.
I mean, the Chinese banking system has done most of its growth since 2008. I mean, it has happened very, very fast. And then now you've got their banking system so ridiculously big, i.e. so much more over leverage versus the amount of capital they have on hand, that it takes just very, very small pullbacks in those real estate values or vacancies and that sort of thing before it quickly adversely affects those Chinese banks and the Chinese bank balance sheets, for sure. So that could happen a lot quicker. I mean, you could have very, very big credit problems spanning throughout Asia simply because of that Chinese story. Now, how does that apply to Japan? Well, right now, the yen has been rallying because of this, right? On this idea of a safe haven. Well, Japan's largest trading partner is China. So a cheaper yuan and a more expensive yen, well, that doesn't exactly help Shinzo Abe and the exports of Japan. So what do we see next? In the currency war environment, luckily I've become good friends with Jim Rickards, so I get to throw currency wars even though it's his book. I get to throw that term around a lot. And the next wave of the currency war in Asia is Japan sitting there saying, well, crud, the yen's rallying. We got to do something about this. So that will be their cover of, hey, we need to spend more, we need to print more yen, we need to buy more assets, et cetera, et cetera. So I see devaluation of the yen coming as an answer to the recent weakness in the yuan.
Mm. Trey, let's get your thoughts on gold. Obviously, we're talking about actionable advice, and you have 6 years worth of charts and just history of what has been going on with gold. Why is gold important in 2016?
Well, number one, because of what I tell you, what's going on in China. If you're about to massively increase money supply in China, then that money is going to go somewhere, and that's going to make gold prices look better. So one actionable item is you either short the yuan or you buy gold in terms of yuan. So you buy gold and short the yuan. That's the other way to do that. But the 6 years worth of charts that I referenced, there's a little more to that story. Getting 6 years worth of gold charts is not that big of a deal. The 6 years of charts that I was referring to, there is a this is gonna require a little bit of nuance. I don't want to get, I must admit that my writing and my speaking style, because of being on the trading floor for 18 years, I use terminology, I use floor terms, and I apologize to your listeners. I talk too fast. I use kind of that goofy terminology, but just bear with me here, and I'll try to explain. Like I said, what I think is an actionable trading idea.
Okay. Well, you're doing great, by the way.
Thank you. Practice, right? At the COMEX, where they trade gold futures, this story is not new. That the COMEX is what's called a fractional reserve exchange, meaning that right now, the number, I pulled it up just the other day, and the amount of gold in registered deliverable inventory, they trade 128 times more gold in paper than they do versus the amount of gold that they have in actual registered deliverable inventory. That's a lot of leverage, 128 times more. It's been higher, it's been lower, but the point here is, and where this trading idea is coming from, is that gold at the COMEX is not actually gold. It's fake. Mm-hmm. And what I mean by that is that until you get into the delivery period, okay, remember what a futures contract is. A futures contract is a contract for future delivery of a specific commodity at a specific date in the future. Mm-hmm. Now, if you look at, let's say, the October gold for 2016, if I buy October gold and somebody sells me October gold, I can't go to that seller and say, hey, back up the truck and give me the gold. You can't do that. However, once it actually gets to October, the long, me, if I own the gold, I can say, back up the truck and give me the gold. So once the futures contract gets into that delivery period, the longs can cross their arms, like I'm doing in my office right now. You just can't see me because we're doing an audio-only interview. But they cross their arms and they say, give me the darn gold. Now the shorts, they have to deliver that. That is a contractual obligation, hence the name, futures contract. If the long says, give it to me, then the short has to go get the gold out of those registered inventories and deliver it to the long, right?
Right.
So if I'm sitting there telling you, you want to talk numbers? The amount of gold that's actually in registered inventories right now is $300 million worth of gold. Now, that's a lot of money, clearly. I mean, that's more money than any of my friends have just laying around. But $300 million to a sovereign wealth fund or something like that, that's not an awful lot of money, okay? So you do realize that the amount of gold traded in the paper at COMEX is $44 billion. That's how that works out. So they've got $44 billion worth of open contracts, but there's only $300 million in actual gold that can be delivered. So here's where the actionable idea comes from. As you approach delivery, those short positions, like right now, the lead month in the gold is the February contract. So if I'm short February gold, and I know that at the beginning of February, there might be somebody who steps up and says, give me the darn gold. Don't you think it's logical that those shorts want to get the heck out of the way? They don't want that risk of the long saying, give it to me, give me the gold. So what's happening right now is, and this is literally happening on my screens as we speak in this interview, you're seeing February gold gain ground on the next month out, which is the April, okay? So as I'm watching Feb versus April, Feb versus March, those short positions are actively rolling. And what they do, if you think about it, and think about this visually as arrows going up and down. If I'm short February gold, that means I have to buy the February. That puts upward pressure on Feb. And if I'm going to roll it and put my short position in April, well, so I'm going to be buying Feb and selling April. Mm-hmm. So what that ends up doing is it makes that spread narrow as you get towards delivery. I've got 6 years worth of historical charts, and it is the most obvious pattern you've ever seen. As gold approaches delivery, the shorts get out of the way. There is a trading idea buried in that. And that's what I've been working on now for quite a while. So here's what investors should do. Buy the February gold, sell the April, hold it as it goes into delivery. When the shorts start running for cover and they move their positions back, the spread narrows, and that's where you're looking for profit. Wow. This is not that hard to do. It's very, very simple. So that's what I've been advising clients of mine. Is the trade exciting? No, it's like watching paint dry. However, it's awfully consistent. And if you look at those charts that I'm talking about, As it approaches delivery, the front month starts gaining on the back. Okay, I'll go along for the ride. Now, here's how that trade turns from a consistent winner, where it goes and then the spread narrows. Sometimes it just goes sideways, but oftentimes that spread will narrow. But every now and then, like if you'll look at the last December contract, the December contract went bananas. And the reason is, what if somebody steps up and says, give me the gold, I'll take it? What do you think these spreads do then? Now the shorts have got to pay anything to roll those positions back. There's opportunity here. It requires a discussion of your risk tolerance. It requires what position size is appropriate. But why not exploit the COMEX? Why not? That's my job. I'm not an activist investor. I am a selfish profit seeker. That's it. And so if they're going to sit there with their fractional reserve currency, fractional reserve exchange, then it is to my best interest to exploit that. And if your listeners want to know how to do it, have them send me an email. I'll explain exactly what I'm doing. If you want to see these 6 years worth of charts, happy to send them to you. You can draw your own conclusion.
Trey, that's incredible, and it's a beautiful thing how you've been able to consistently generate income with this strategy. Now, have you seen any sort of trend in terms of what you've seen over the years as far as maybe a break or an actual run on the COMEX that is going to come, or is it just this dynamic that can go on for a very long time?
Sure, it can. But if this trade happens 6 times a year, and we can make money 6 times a year with the threat that if somebody actually steps up and takes it all and just completely turns COMEX inside out, okay, I'll go along for that. All right, seems reasonable to me. It's just a matter of how you gear it. How big a position do you want to take versus the amount of money in your account? So, I'm not going to sit here and talk about percentage gains and all that nonsense, because that says it's different on how hard somebody wants to push their money and how much risk they want to take, as with anything else. But that you have to have that discussion on an individual by individual basis.
Sure. So Trey, let's talk about gold in China. I mean, China is importing a lot of gold, and it's questionable in terms of how much gold they really have compared to what they announced.
Hey, time out. Shameless plug coming. You ready, listeners?
Let's do it.
I already told you I'm friends with Jim Rickards. He's got a new book coming out. It is about gold. And the guy, what is he? A 3-time New York Times best-selling author now? 2 times?
Like
I don't know. Enough that you ought to be paying attention to what he says. He's got a new book coming out. I think it's coming out in April. Be on the lookout. I just requested my copy of it so I could read it before it comes out. But be on the lookout for the gold book by Jim Rickards coming out here in a couple months.
Okay. Well, hey, any thoughts on what's going on with China, what they're doing? You talked about the yuan devaluing, but what about their gold position? Are they hedging themselves for what is to come?
Well, do we really know what the Chinese gold position is?
No.
They're shameless liars and they do nothing but deceive financial markets. They lie about company reports. They lie on government reports. So who knows how much gold they have, how much they want. But I can tell you that if I'm a prudent Chinese investor, I darn sure don't want to hold any Chinese yuan. Why do you think they've flooded their money into Australian real estate and Mexican real estate, et cetera, et cetera? They're doing all that to get the heck out of the way. Mm-hmm. They're doing that because they don't want to hold the yuan. So would I imagine normal, prudent Chinese investors to be actively trying to buy gold and silver, for that matter, for the sole purpose of reducing that currency risk? Because they're not dumb. They see what the government's going to have to do, and that government is going to be devaluing that currency. Plain and simple.
Trey, this is just kind of my last question for you. It's kind of a little bit off topic from what we were talking about, but you worked on the floor at the CME, so you got a real pulse for what trading looks like, compared to the average person, and it was evident with the way you spoke about the COMEX and explained yourself throughout the interview. But the Bank of International Settlements estimates like 1 quadrillion in derivatives that are going on around the world. And I want to ask you, from your perspective, what does a derivatives credit crunch look like if we were to see that happen?
Well, the one that I see happening sooner rather than later is some sort of a credit crisis coming out of Asia. It starts with the Chinese banks. Now, if those investors in those banks, now they can't get their money, et cetera, et cetera. So that's where I see it starting. Where I gave the illustration of the real estate, the high-rise real estate building. Suddenly they can't make their payments. Now the bank comes under pressure, and then so I would imagine I would see pressure on Chinese bank stocks. But I mean, who knows? Because I'm not saying go out and short Chinese bank stocks, but I would imagine that they would come under some pretty severe pressure. But we live in a very, very connected world. In my office, sitting here in Dallas, I'm overlooking the North Dallas Tollway, and across the street from me, there's about a 5-acre development going on, and it's great watching all the construction. What's the likelihood that some capital from that development right there came from outside the U.S.? I think it's probably pretty good. Mm-hmm. So we absolutely live in an interconnected world where, what's it, the butterfly effect? The butterfly flaps its wings across the world and it creates a tsunami on the other side. Mm-hmm. When you take what's actually going on in an economy and then you start multiplying it with the derivatives. Now, I happen to be a derivatives trader, so please don't take this as some sort of an indictment of derivatives. Not at all. But does it have the ability to magnify effects? Well, it's not actually derivatives that are magnifying effects. It's margin and it's leverage that manages to magnify those effects. And I would say that the world is levered out of its gourd right now. So that in and of itself will magnify effects of, say, a Chinese banking system problem, of a noticeably weaker government debt market in Japan or whatever. So as much as your listeners want to sit there and say it doesn't matter to me, it most certainly does. Because what if I'm a U.S. bank that's heavily invested in a Chinese bank, and now that Chinese bank is invested in high-rises that go under? It's all connected, and leverage is what creates that risk. It's not the derivatives themselves.
How much leverage then can disappear in some sort of credit crunch? Obviously, in a panic.
Depends on the crunch.
Yeah, I know.
It depends. But wouldn't you say that that's what, in some ways, that we have had? Look at everything that you had hinged to crude oil. Mm-hmm. Now, crude oil's gone from 90-something to 30-something. Can you imagine all the lending that was going on against oil rigs and developments in Texas and the Dakotas and this, that, and the other? Absolutely, all that kind of stuff is they're interconnected.
It's already happening.
Naturally, yeah, it's already happened. It's already happened and still happening for sure. Mm. So, yeah, with all that amount of interconnectedness and all that amount of leverage, guess what? It takes a while to unwind that stuff. And believe it or not, when you take all that debt, like in the United States with the real estate bubble, you had all that massive amount of leverage. Well, where did that leverage go? That leverage went over to the government balance sheet because you've increased leverage there. Government debt has skyrocketed in the last 8 years. And so in theory, all you did was you took that leverage off of AIG and et cetera, and then moved it over to the public balance sheet. Yeah. You're just moving debt around. You're not actually paying any of it off.
And that negative energy will need to be released at one point or another. Trey, in terms of deflation, inflation, are you thinking that we're going to see deflation first in terms of the U.S. dollar if we see countries like China see their currency massively devalue, their economy cripple? Will we see a run to U.S. dollars and then ultimately some sort of demise of the U.S. dollar just over the decades, or inflation first?
Well, that's a tricky one. Number one, it's got about 7 questions buried all in the one. So let's just let's start out basic. The U.S. dollar right now, we are doing no QE, but that's going to change. We'll be back to doing QE. But I just told you a scenario where the Chinese are going to be increasing QE. So what you want to do is you want to be currencies that are increasing QE, and you want to be long currencies that don't have QE, right? Well, right now, we just raised rates. That's dollar supportive, okay? And I see the situation where the Chinese are about to do massive amounts of QE. So, yes, I will stay with my positive dollar forecast. However, I'm also not a complete moron. And what I'll tell you about the dollar is is that the dollar is catching strength, not because we're doing anything that's particularly dollar positive. It's just that everybody else is doing things that are so negative, their currency. Suddenly we become the tallest dwarf, shall we say.
Yeah.
Granted that what we're doing in the long term is not creating a strong dollar picture, not by any stretch of the imagination. However, we just don't currently happen to be in a round of QE, and Europe and Japan, my God, their QE is world renowned, and they're still doing it right now. And Japan is applying that great principle of, hey, we're doing something and it's not working, so let's do lots more of it. That's genius, right? So you're going to have more QE coming from them, more QE coming from China, more QE coming from the Eurozone. See where I'm going with this?
Yeah, no,
so
it makes...
start ours. Yeah, we're going to look relatively good here.
We're in a closed-off global economic system. The world has only so many places to go, and just because everything's bad, they only have so many choices. Now, some people feel that the choice of last resort is gold, and it's not really a currency. And I think there's a lot of truth to that as well. But we're getting to the 35-minute mark, Trey, and I just want to thank you so much for coming on the show with me today. I just wanted to give you an opportunity, if you had any last thoughts, and just to share with our listeners how they can act and profit with you with these strategies.
All these strategies, you have to have a discussion of risk. I don't know what's appropriate because I haven't talked to any individual people. So let's solve that right now. I'm going to give you the same email address my mom has. It's Trey, T-R-E-S, as in Sam, T-R-E-S, at shortjapandebt.com. Or you can just go to shortjapandebt.com. There's a big button on there that says email Trey here. You can go there too. Reach out to me. Say, all right, I got some questions. I want to know this, that, and the other. And then we can have this conversation. We have the conversation about risk, sizing of the positions, what's the best way to do it, et cetera, et cetera. That's your starting point right there. And after that discussion, listeners might say, you know what, that's just not for me. That's too much risk. It's not enough. I don't agree with Trey's economic philosophy. That's okay. We depart as friends and away you go. It's as simple as that.
Well, Trey, I really appreciate you coming on the show and just sharing with us your knowledge. Anyone who wants to check him out, do so. We'll have the links in the description area. Thanks so much for coming on the show with me.
You bet. Looking forward to being on again.